The U.S. Federal Reserve went ahead with another rate cut, raising questions about its balancing act between controlling inflation and supporting economic growth. Our Moon Hye-ryeon starts us off.
The Fed has cut rates once again despite slower than expected progress made on inflation in the United States. On Wednesday local time, following the last Federal Open Market Committee meeting of the year, Fed policymakers slashed the benchmark interest rate by 25 basis points, bringing it down to the 4.25 to 4.5% range. The latest action brings the total cut made since September to 1 full percentage point and comes despite inflation continuing to remain stubbornly above the Fed's 2% target. The U.S. Personal Consumption Price Expenditures Index, the Fed's gauge of inflation, rose to 2.8% in October, while the Consumer Price Index jumped 2.7% in November.
We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment.
Fed officials also made some adjustments to their forecasts for next year, projecting a slower pace of rate cuts compared to its September forecast, as well as persisting inflation. By the end of 2025, they see 2 rate deductions of 25 basis points each, which is half a percentage point less than what they anticipated 3 months ago. Inflation forecasts also jumped from 2.1% to 2.5%. These are the first projections since Donald Trump was elected the next president of the United States, and Powell remarked that it is premature to make any conclusions on how possible tariffs could affect consumer inflation. Following the Fed's decision, Wall Street tumbled, with the Dow Jones falling for the 10th day straight to mark its longest downward slope since 1974. The tech-heavy Nasdaq and benchmark S&P 500 also tallied their largest drops in months. This latest decision from the Fed brings the interest rate gap between South Korea and the U.S. back down to 1.5 percentage points, after it widened to 1.75 percentage points in September. Finance authorities, including the country's finance minister and the Bank of Korea's governor, held a meeting on Thursday morning to discuss these developments and the domestic economic situation. The finance ministry and central banks said they would continue to operate an around-the-clock system to monitor the foreign exchange market and pledge to do their best to stabilize financial markets. Moon Hye-ryeon, Arirang News.